Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 121 for March 31st, 2020. We are recording this at 4 p.m. Eastern Time, and my name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing your trade ideas. So over the last few days, about 40 people submitted up to 5 symbols each, and I've put the list together that we're going to discuss today, and I have arranged for John Thomas and Jim, the option professor, to join us, and Jim will be moderating, so I'm going to go ahead and turn it over to him.
Okay, thanks, David, and thanks everybody for being here again. Thank God this month is over. It was one of the worst months in history on a percentage basis, and so we'll look at April, and hopefully we'll be able to get a little better result at the end of April. Right now, we're going to go through 15 different stocks that you got, and also give you a quick overview. But before we get started, our guests and a little bit about what's going on at the Mad Hedge Fund Trader. John?
Well, hello, everyone. This is John Thomas, broadcasting you live from an undisclosed location near Lake Tahoe, Nevada, where the epidemic hasn't really hit yet. Of course, we have no people up here. The only thing up here this time of the year are bears and deer, a few elk sprinkled in. I've been in the market for 50 years. We have a research and trade mentoring service called The Diary of a Mad Hedge Fund Trader. We cover stocks, bonds, commodities, precious metals, energy, foreign exchange, and real estate. And I'm happy to say our trade mentoring service just finished the quarter down a whole 8% versus a Dow average that at one point was down 37%. So you can visit my website at www.madhedgefundtrader.com. Sign up for our free research there, and we'll get you into the system. And that is about it.
All right, John, let's go into some of these stocks here. But before we do that, a little overview on we're at the S&P. Looks like on the SPY 257.69, and we did roll over pretty good today at the month end. What are we thinking here right now?
Well, this is a market that is begging for a retest. You know, it hit the first Fibonacci level, up a third from the lows. In a stretch, we might make up half the recent loss, but that's unlikely. What is more likely, we go back down and retest the lows. However, next time we go down to the 2200 level in the SPYs, the bond markets will be open and backstop with $10 trillion worth of federal spending, who started buying bonds they've never bought before in history, like student loan debt, municipal bonds, credit card receivables, you name it. So with that in place, I'm not expecting new lows anymore, but definitely a double bottom test. And at a minimum, we would give up half of the gains since last week. So if that happens, that may be the buying opportunity of the century and the beginning of the new roaring 20s, which I am also predicting for the next 10 years. I would urge people to do trades, because with implied volatilities at 60 or 50, it's almost impossible to lose money now on spread trades. You just have to remember to buy low, sell high, and you can make a lot of money in this market now.
Yeah, at the end of the day, with the VIX at 60 and anything really over 30, you can anticipate a trading range from the standpoint of to work off the excess of that VIX, and also for the moving averages, to catch up to the prices. So that's why a wide range of maybe 2850 to 2000 might be the way it works here for the foreseeable months, huh?
By the way, you should also be shorting VIX up here, and you can do that by buying put options on the VXX. Yesterday the VIX traded up to 60. August VIX is already trading at 30. So that's almost a guarantee that you'll make a ton of money on any short plays going forward. And we have big positions in there on the short side already.
I got a question for you. You know, obviously, it seems to me like a consensus is being made that the lows might be in, and that most of the bad news has been discounted. Now, there's always a flip side to every pancake. And on the flip side, I would say that with a total unknowable earnings and total unknowable defaults and an unknowable employment rate and an unknowable many unknowables.
Yeah.
It'd be hard for anyone to really discount the fact that we could take out the low and put into play that 1800 area, which would be a 60% drop from the move that started in '08 and ended last month. And if that were
I
to
would take
happen,
issue with your statement that all the bad news is in.
right. I mean, people we're saying that though.
Let
They're
me
acting
ask
as
you,
though it's discounted.
are 100,000 deaths priced into the market? No.
Yeah.
Uh, you know, is the worst economic data points in history priced into the market? No. You know, people say, oh, well, we know the non-farm payroll is going to be bad. What if they come in with a non-farm payroll of minus 3 million
Yeah.
against plus 200,000 in the previous month? A weekly jobless claims tomorrow could be another minus 3 million. So,
And
um,
I saw in the news the New York MTA is asking for the government to help them to make their next coupon payment because nobody's taking the train. So there's going to be some other shoes that drop, and some of them might look like Ronald McDonald shoes.
well, and also, you know, there are all of the unintended consequences, which
Right.
normally you see like 1, 2, or 3 at a time. Now we're talking about 1, 2, or 3 million unintended consequences.
Yeah.
You know, I bet you didn't know there's a sudden chicken shortage.
Okay. There you go.
Well, chickens make eggs. Eggs are used to make vaccines.
Oh,
And suddenly, at least 50 different vaccines are in trials right now. So you can't get chicks or chickens anymore.
hmm. No, I
And
didn't hear that one.
every aspect of the economy is now encountering dozens of unintended consequences, which were never ever dreamed in their wildest nightmares. And we'll just have to wait and see how they play out. I mean, who knew the first thing to happen is that all the toilet paper in the country will get sold out? Well, I knew because our Australian customers in January were sending me pictures of supermarkets with all the toilet paper cleaned out. So what did I do? I went over to Costco and bought a year's supply.
Yeah. Well, the other thing around the world, not everyone has an election in November, so I don't know how the rest of the world is going to snap back. You know, Australia's got a lot of problems, as well as all throughout, Asia and Europe. And some of the insurers over in Europe look like they're on dicey ground. So, this idea of the V-shaped recovery or get it back up before the election, um, they certainly are trying to spend as much money as possible because they've got an infrastructure bill they're trying to push now, in addition to another stimulus package. So,
Right,
uh,
but you know, the market isn't exactly cheap here. All
no,
we've gone is from a 20 multiple down to 14,
right,
but that's based on last year's earnings.
right,
You know, based on this year's earnings, we're probably at a PE multiple now of like 25 or 30.
yeah.
So you're not going to get valuation support from this market at all. Just the sheer absolute level of prices, the low prices are going to start to bring people in.
I got another question. Do you think that the growth tech sector, which really has not gone down like the rest, ultimately has to go down before we're ready to turn, or are they going to be abstained from that?
No, I think in this market, and the same in '08 and the same in the '87 crash, you want to buy the things that only went down 30% and avoid the stuff that went down 80%.
Right.
Because the highest quality stocks held up the best.
Yeah.
Microsoft is actually up on the quarter. It's
Right.
the only Dow stock this year that's up. And Apple, at its worst, was only down 35%. So high quality tech is where you want to get your money and get the best quality. You know, get the Cadillacs and the Rolls Royces at discount now. Don't
Right.
use the best prices ever to buy a Fiat or a Volkswagen or a Robinson Reliant, if anybody knows what that is.
So tech and growth would be the two areas to focus on if you're kind of staging into this,
And
as opposed
biotech. You know, I think
and biotech.
first of all, this crash scares away all of the regulatory concerns about healthcare and biotech
Right.
basically forever. But also that whole industry, it just had all regulation pulled off it. They're pulling forward 10 years worth of research literally in a couple of months. So that's going to create a massive earnings boom in healthcare and biotech, which we just so happen to have a newsletter about.
They also seem to be throwing out the door all the banking regulations too, because that CECL that they were supposed to relook at loan quality, that's totally out, suspended for 2 years or
Yeah,
something
that's
like
just a
that.
short-term deal. And by the way, the only reason these banks still exist today is because of all the banking regulation they
Yeah.
threw in after the last crash. You know, they're all very well capitalized, and as long as we get out of this thing in a few months, they have nothing to worry about except really low interest rates.
All right, well, let's go around the horn here. We're going to start out with Boeing. We went all the way down to 89 bucks, went all the way back to 181 bucks, and now it's back at 149 bucks. What are you thinking here? If David could throw up the chart on Boeing, BA.
Well, Boeing is one of the most interesting, stocks in the market. We've been following this for basically, 40 years. I'm rated on several Boeing aircraft myself as a pilot, including a B-17 bomber from World War II. Boeing's in a situation where it's considered a strategically important stock, a company in the United States. So one of two things will happen. The government will take it over and then approve the Boeing 737 MAX, and the stock then rockets. Or, Boeing keeps control of the company. They approved the 737 MAX as a stimulus measure, which they were going to do anyway in a month or so before the virus hit. So, you could get an easy double or triple on this stock as long as the company doesn't go bankrupt in the next couple months. So it's either a zero or a triple is what you're looking at. And it's really almost like a penny stock, You're either going to zero or you're going to triple. It's one or the other. And the government holds all the cards on this one. So I tend to think Boeing's going to survive. And actually, we got flooded with emails when Boeing hit 100. Should I sell? People who lived in the Northwest, they had it in their pension funds. They've had it all their life. And I said, no, you've missed the,
300 points ago.
Don't give up the dead cat bounce. And the stock doubled in the next 3 days.
Yeah. On the pullback, 40% drop would take you to about 125, and a 60% drop off of the recent run would take you to about 127. Excuse me, 145 ballpark on the 40% drop, and it's almost there. And then the other one would be 60% would take you to 127. Would those be two areas that you might take a bite at it? Those areas?
It would. And let me tell you the most likely scenario for Boeing. One day, the government is going to announce they're going to take a 10% stake in Boeing in exchange for a cash infusion, and they approve the 737 MAX to fly. Now, on that day, we soar well over $200 a share from today's 152. So if you want to do leaps, this is a great candidate for a leap, 1 year, 2 year leap. Call spreads. Buying the stock here is a little risky because we could revisit 100 one more time. So yeah, I'm a believer in Boeing, and now you're just looking at wasting.
I was thinking their debt was great because it was paying about 8 to 10% 2 weeks ago, and 8 to 10% on Boeing seems like a pretty darn good rate. Those rates have dropped, but they're still pretty reasonable. You can still get 4% on Boeing.
Yeah, any debt right now is a fantastic deal.
Yeah.
I mean, Tesla convertible bonds now are probably yielding something like 10% or more. And that isn't really tied to the company. That's more a function of the private debt markets completely shutting down. And they didn't reopen until the Fed came in as a massive buyer. So,
one last question.
I got for yield, who are reaching for yield.
Right.
Now it's paradise.
Yeah.
You got blue chip companies, formerly AAA rated companies, yielding 10% now. So I'd go heavily bond shopping, especially if you're over 60, 65 years old.
Yeah.
like me.
Yeah. Who wouldn't mind a little cash flow coming in rather than that 0.01% money market that's going to be happening before we know it?
Yeah.
Obviously, the Fed's reinstituting kill the saver, get everybody taking risk again. So that if that's the plan, you got to start locking in some yields at some point.
Yeah. Well, they've been killing savers for years, so nothing new there.
Apple, AAPL.
Yeah.
What are we thinking?
Well, again, you know, uh, $200 billion worth of cash in the company. Chinese production is coming back online. The only question is how much of a dent in iPhone sales they're going to have. It's obviously going to be a huge dent, but any revisits back to the 200 range, I'm a buyer. A week ago Monday, I was looking at the 140, 150 call spread for March. I could have gotten like a 20% profit in 9 days on that trade, and I didn't do it because you just had just a series of cascading down 1,000-point days that you just couldn't buy anything at that point. Now I do that trade all day long, except to get the same return, you have to do something like the 210, 220. So long term, yeah, this is quality. This is your Rolls Royce play. I'd be buying dips basically forever on this stock from now on. Just to get back to the old high from today, you're looking at minimum 30% return. And
there's a gap on the graph between
back up to about 3% now.
Yeah, there's a gap between 225 ballpark and 235. Maybe if the market gets shaky after they announce unemployment, that might be a neighborhood to take a look at it. 225, 235, something like that.
Well, it's not just non-farm payroll. I mean, we got the weekly jobless claims tomorrow. We got non-farm on Friday.
Yeah.
You're going to have GDP numbers that are like negative 30% coming.
Right.
In a few weeks. I think the first look at Q1 GDP is going to be the third week of April. And these are just going to be unprecedented numbers. And these are just not going to fall off like water on a duck's back. These are going to get market hits. And depending on where we are, you may want to buy in on those or just, go take a nap.
Yeah, one of the companies connected to it, Cirrus, was recommended by some people on one of the analysts were saying, and that actually was up 2.5% today. Do you have any comment on Cirrus Logic? Because again, some people were saying because of the iPhone connection that these guys could maybe not be a bad place. It used to be a $92 stock, went down to 50, and now it's in the 60s. Do you have any opinion on Cirrus?
Sort of Apple feeder stocks that you can look. Qualcomm is the one I bought. QCOM is the ticker symbol.
Okay.
And, there's maybe 50% gain in that one. So, all the part suppliers, chip companies. You notice chip companies have already covered half of their loss this year. So, again, that's another really fertile area to be looking at. Micron, Advanced Micro Devices, and NVIDIA.
Well, let's talk about those three, I was going to talk about the next one on the list, which is AMD. But we'll also talk a little bit about NVIDIA and also the SMH in general. What do you think of AMD right here?
Well, you can see my 50% retracement, and all three of the stocks show the exact same thing. And this gets back to my, buying the Cadillacs and the Rolls Royces at half price type stocks. These are stocks that we've been recommending for years. They are major secular uptrends. 5G is about to create a massive chip shortage as everybody in the world moves up to broadband that is 10 times the existing wavelength or capacity. So you absolutely want to get into these things and take this as a gift. If we get another visit into the 40 handle, low 40 handle in AMD, man, I am there all day long. And I would do something, if we get to 40, I'd be doing something like the 50, 55 leap 2 years out. Right. And you might be able to get 100% return on that in a year.
You know,
100%
NVIDIA is another
return
one.
on a 25% move.
Can we look at NVIDIA real quick?
Oh, yeah,
NVDA?
sure. Yeah, put it up.
Yeah, because again, that's another one that fell all the way to 180 and bounced all the way back here into the 260s. It's off a little
Yeah.
bit today, but
Yeah, we've been recommending this for 5 years, ever since it was in the low 60s. And again, you can see the 50% retracement. This is where the smart money wants to go on any recovery. So any chances you get to get into this cheap, like a visit back to the 200 handle, I would be just all over that. And I would be buying stock outright, buying long-term call options, or I'd be buying the leaps. And on this, if you did something like a 250, 260 leap 2 years out, you'll get 100% return on that in probably a year.
there is one REIT that it's also connected, I think. And if you can put this one up, it's connected a little bit to the 5G and all that. AMT, American Tower.
Yeah, American Tower also we've been recommending, but there's a better one, and that's Crown Castle International.
Okay.
They put CCI up.
CCI?
Yeah, if you can. CCI has a much higher concentration in 5G cell towers, which are about the size of a suitcase.
Right.
The old 5G towers are 200 feet tall. You see them all over the country. And also, they have a much higher dividend. They had a dividend that was double.
Much higher.
Cell tower makers. So
yeah, twice the dividend. Yeah.
And we actually were, even when the market was crashing, we were begging people to get into this thing because the dividend was so high and the future on this is so clear. I mean, an epidemic is not going to destroy demand for cell phone towers. If anything, it's going to create more demand because we've all gone digital and online and virtual. So yeah, and look, this has recovered even more, like 2/3 of its low has been recovered already. And that shows you this is on the short list of all the big institutional investors long term.
Yeah, I mean, it definitely is part of that structure, the infrastructure that people are talking about, rather than go to the consumer electronics, which could be dicey because the consumer is not going to know whether to poop or go blind after 2 months in hibernation. The infrastructure on the 5G should be a more solid deal.
Yeah, and if you go to my website at madhedgefundtrader.com, just do a search for Crown Castle International, and we have a major research piece on the whole cell phone tower industry. It was attractive even back in January.
All right, well, this next one up is a trading vehicle that people use when they want to go short the S&P. So this is SDS, and it obviously had an enormous move from last month to the high of this month, but it had a huge pullback as well. So SDS, if we can see that,
Yeah,
that's about a 60% drop,
yeah,
a little bit more maybe.
We bought this yesterday.
Yeah.
And again, we think that you're going to have one more run at the lows. You won't get all the way back up to 45 or whatever the high is on this, but you might make it into the high 30s. So there's potential 30% return on this. And this is like a 2x short S&P 500 ETF. And there's tons of liquidity because the hedge funds are trading this all day long against the index and against, with their algorithms. So even if we retrace half of last week's gain, which is about 4,000 Dow points or 450 SPY points, this thing would rise 30%.
And there's a gap between about 38 and 40 there, or 37 and 40. That might be the neighborhood that it would retrace back in if we, get a bunch of selling because these economic numbers make people's dentures fly out. Yeah. I mean, I don't know what to expect, and I don't know how people are.
I kind of do,
Yeah.
And the analysts' projections are based, for last year, based on a S&P price earnings multiple of $165 a share.
Right.
And their worst case scenario is like $140 a share, with huge chunks of the economy closed and many, Dow stocks seeing 90% revenue drops. You're going to have S&P earnings drop below 100.
I would think at least that. I would think at least that, who
Yeah,
knows?
they're going to go back to 08, 09 levels. So is 20% enough of a sell-off to adjust for that?
Well,
Absolutely.
when a Fed governor comes out and estimates unemployment to be between 10 and 42%, it leads me to believe that I am in no position to guess.
Well, and that's all the Fed is doing is guessing.
Mhm.
And yeah, we know there's 10 trillion that's going to hit the economy, but when are people going to start riding airplanes again? When are they going to start going to the movies and eating out and booking cruises? That could be a long wait. So a lot of these economic numbers are essentially meaningless right now, and sentiment and watching the epidemic as adding more value to your trading right now than anything else.
Yeah, this next one, CVX, I picked up some of its neighbor Mobile on that big drop that we got because, I'm not a believer that the oil prices will stay down forever, and I'm not a believer that Mobil and Chevron are going out of business. So when they go down to 50 and 30 and 28 and stuff like that, I find it to be at least a worthwhile thing to throw your hat in the ring. And Chevron's CEO was on TV acting as if they're really going to try to defend that dividend as much as they can. So at any rate, this thing had a big move, 50% jump off the bottom. And again, a lot of people are trying to figure out, are these oil companies gone for good, or is there an opportunity down here because they are very out of favor?
Well, we've been predicting the end of the oil industry for years. Basically, it's happened with the stocks all down 80%.
Right.
I think you lose all of the lower and middle tier of the industry.
Right.
Oil prices are going to stay, lower for longer than people realize. There's no place to store. All the storage in the world is full.
Yeah.
And the only way you can get out of this is to close your wells, but then that, permanently impairs the production of the field. So there's just no easy way out of this. And, the majors, like a Chevron, will survive,
Right.
but they are insane to pay a dividend in these circumstances. They should really keep that money as a cash reserve for this thing lasting longer than they expect. So even if, OPEC and Russia got together and made nice again, the fact is there's just no demand for oil right now, and all the world's storage is full, will be for years. And it's really hard to come up with a bull case, and this is a classic example of, well, do I buy the down 80% or the down 30?
Right.
And the answer is you don't buy the down 80%.
Right.
And buying Apple and, Amazon and Microsoft all day long and just, let this one twist in the wind for as long as it takes to recover.
Yeah. No, there's no question. Crude is, down in that $20 range. People are talking 15, 20. Then there's the guys talking about 10. I don't know about all that. I just thought that at the end of May, because, I've been listening to the reports pretty closely. Saudi has said they're going to pump until the end of May, and they're not kidding around, obviously. So if they do change their entire course after May, and everybody gets out of their house and goes a little bit of nuts on demand, is it possible you can get a throwback rally out of here? And I think it's not impossible.
Oil from 20 back to 40, that'll get you a dead cat bounce in some of these oil majors.
That's it.
But, the debt on the small and mid-sized companies trading for pennies on the dollar now. They're already pricing in bankruptcy. So too many better fish to fry. Call me old and spoiled, but, I like buying Rolls Royces at a fire sale instead of beat up jalopies, and this is definitely beat up jalopy.
Yeah. All right. Well, let's go back towards the more techie type stuff. How about Roku? ROKU used to be 176, went all the way down here to 60, popped back towards 100, That 100 number seems to be a real magic number on either side. It's either resistance or it's support, but it's
It's like
definitely a line in the sand, isn't it?
it just keeps coming back to that level.
Yeah.
Yeah, guess what? 2-month national quarantine does. It makes everybody use their Roku devices. So
Hmm.
I would be a buyer down here, a buyer of Leaps. Any way you can get into it. I think this company has a great long-term future, and you want to be getting into it at every opportunity.
The next one really just went through the roof because everyone is obviously doing telecommuting, and ergo Zoom, gets a very, very big in that environment. And it obviously went from $59 up to $165, and now it pulled back here to 146. Is this a deal where it has discounted pretty much all it's going to do, or is there a lot more
I
legs
would
here?
say it has. We were recommending Zoom at the beginning of the year just because it had such a great long-term business plan.
Right.
But how many more global pandemics are we going to get? It's going to be 100 years until we get another one of this severity, and another 20 years till we get another major one. So I think the stock has really outgrown its ability to grow, even in the absolute best of circumstances. So, I would leave this alone. Pat yourself on the back for getting into this one early and take profits,
Yeah.
and get into the stuff that's been really beaten up.
How much weight would you put on the concept that the telecommuting trend that has started will continue and travel by airplane into convention centers and all the rest of it? Is going to with this video communications, so that there could be another leg up if, in fact, human behavior changes after we get
Well,
out
we've
of
been
jail
arguing
here,
all
wherever we
along
are.
that all the virus did was vastly accelerate long-term trends that were already in place. So, moving workers online, virtual meetings, all that stuff, that's already been growing. And this really caused it to go crazy. And once online, a lot of business is never coming back to the legacy for, because companies are finding out how much money they can save doing this.
Right.
So that's why, another reason why I'm not going into the airlines. You may not see traffic recovery for many years off of last year's levels, because it's cheaper to just do Zoom meetings like we're having right now, for example, rather than flying to Las Vegas,
Right.
booking, $1,000 worth of hotels and doing all this in person.
Right. Yeah, for decades I did live seminars throughout the nation and even up into Canada. And the traveling, for me, I didn't mind it because I was going to all these new places. But it's clearly a better deal to be able to do it electronically from the standpoint of stress and everything else.
I was doing 25 speaking events a year up until about 5 years ago, and then everyone figured out that the in-person events weren't making money anymore, and the way to go was online. And since it's been all online,
Yeah.
and the few in-person events that exist, they weren't making much money at it anymore either. So,
And even when I was in Newport Beach, if I had to drive to Woodland Hills to do a seminar, the bumper-to-bumper traffic was a 4-hour deal. So even if you weren't flying, even commuting on the ground was a pain in the neck.
well, even when I was doing my in-person events, I used to do a lot with the Nigerians when they had Auction Monster, and those only made sense if I piggybacked my own events on top of theirs, like customer strategy luncheons, meetings with concierge clients, and so on. So now I just make everybody come to Lake Tahoe.
All right, let's go over to the payment people. Visa came out and said the consumer is the receipts even online purchasing is way off. So I'm going to be expecting consumer sales and things along retail sales and things like that to really fall off a cliff, because Visa has come out and said that their receipts are way down. This one's MasterCard, MA, and 10 million shares today means it's no ugly sister to Visa, but big drop, 350 down here to 240, went down to 200 on the low. Are we thinking there's a deal down here?
Well, yeah, there is a deal here, and the same with Visa, the same with American Express. Initially there's a shock to the system and everybody just freezes up because they just lost their job. They're worried there may be about their job, and they completely cut their discretionary spending to zero. And by the way, 8% of MasterCard's total sales came from airline tickets. I didn't know that. So initially there's a total freeze up, and then when the shelter in places come off, then there'll be a huge spending boom because there's a massive amount of deferred spending going on. A lot of our economic growth is not lost; it's just delayed, and it's all going to get bunched up in the second half of the year. And credit card companies will capture all of that. And in any case, this is a whole other industry where all of the long-term secular changes to the economy were working for them. The wind is in their back. They can all of the online transactions in the world essentially go through 3 companies. 5 if you want to throw in PayPal and Square in there. So yeah, a perfect lead candidate, great long-term buy. There's a double in this on a 5-year view, and there's 1,000% return on this in 2 years if you do something like the, say
Leaps.
350, 360 leap 2 years out.
Let's throw up Square, SQ, because a lot of people were talking recently that Square is really a thing of the future as far as opportunity is concerned. And it dropped down to 30 from 90, so that's a pretty darn good price. And today it's down to 52. So if Square were to pull back, what neighborhood would Square maybe be a deal at?
Here.
Yeah.
This is something you could literally buy right now. You see all those red lines and all that, empty space in between the bars on the downside.
Right.
That's like one share is knocking that price down. One share for sale at market is knocking that thing down 10% at a time. So, this is a very eventually slower growth pattern. So this is the future of banking, basically.
Square, these branches all over town. I mean, here in Las Vegas, there is a tremendous amount of branches, and I just got the feeling they're going to start shutting these things down because they.
Yeah, the United States is the most overbanked country in the world.
Yeah.
There are 4,000 banks in the United States. Australia has 4. So
here's a thing. Here's a question on the banks, real quick. Is that the ECB is encouraging banks in Europe to not pay any dividends, and I think people have been trying to buy the U.S. banks in part because of their dividend. Do you think the U.S. banks' dividends could be at jeopardy at any point?
No company in the country should be paying any dividends right now.
Right.
They should be retaining that money as cash reserve in case this virus thing, stretches out longer than expected.
Yeah, because most of these companies coming to the Fed window are really coming there because they blew all their money on stock buybacks when the market was very high, and so
Boeing is the poster boy for that.
Yeah, yep.
Boeing bought back 33% of its stock in the last 20 years, and now they're out of money.
And the airlines as well. I think 3 airlines have hardly enough money to last 6 months or something, and the other 3 are okay for a year and a half, something like that.
Yeah.
I skipped over one, and I know it's one of your favorites, so mea culpa over here. Tesla, TSLA. Let's put that one up and bring this thing up. And,
if you can get back to the old breakout level, which was 394, I'd be a big buyer of Tesla for the long term. You're back at the price. Well, you're back at the price where it was a few months ago, but we think this is the next $1 trillion company in the stock market. Its market cap today is maybe 100 billion, maybe 90 billion. It could go up tenfold from here. We think their car production is now at 500,000. That'll be 5 million in 10 years, 5 to 10 years. And all their plants are shut down right now by government order, but they'll be the first to come back. In the meantime, they're making ventilators.
So you think trading against that recent low of 350 is
Yeah,
not a bad? Is not a bad.
394 was the old peak of the stock that lasted for about 3.5 years.
Right.
That would be a fabulous support
Right.
point at which you could go in on the long side. And, like a 500, 600 leap on this, or like a 600, 650 leap 2 years out on this would have a 1,000% return in 2 years. And if 1,000% return isn't enough for you in 2 years, maybe you ought to find another newsletter.
Right. Well, I tell you, the biotechs and the drug companies are definitely on a roll here, and Gilead at GILD
Yeah.
is obviously one of the front runners, but that's been having good and bad news. We're in up to 85, back down to 74, so it's a little bit like a Geiger counter here, but the overall flow still seems to be somewhat upward, and the moving average, as you can see, coming in at 70 is still ascending, so that's not too bad. What do you think here on GLD?
I'm also the editor of the Mad Hedge Biotech and Healthcare letter.
Okay.
And we had a long-term buy on Gilead Sciences from last fall.
Mm-hmm.
Obviously, the thing has done spectacular. They're in the front running for one of the first corona cures. Yeah, any dips down to that 50-day moving average, I'd be a buyer of this. We're about to enter the golden age of biotech and healthcare.
Mm-hmm.
Because this whole epidemic is compressing 10 years worth of research into a couple of months, vastly accelerating the development of every kind of drug out there.
Let's look at two other stocks that are in the news here. Johnson & Johnson. Can we put J&J up there and take a look what that looks like? J&J?
Yeah, J&J also has another drug in testing. It might be out in a couple of months. And this stock was held back for years and years from all the litigation
Right.
that they were suffering over
Talcum powder and everything else.
asbestos in the talcum powder, and other. They had multiple product lawsuit, class action lawsuits going on. It finally broke out from that in November, and then got slammed with the epidemic. So yeah, I'd be a buyer on dips on this. And all of a sudden, people are revaluing the entire industry with a fresh set of eyes.
I think it's one of a couple of companies that are really AAA rated, and so obviously the balance sheet must look pretty good as well.
Oh, and this is one of the classic blue chips of all time.
Yeah,
it's one of the. This is, my grandmother bought their products.
Right. How about AB? How about we put up Abbott Labs, ABT, and that's another one that's in the news here with their testing kit. What does ABT look like?
This is the 5-minute testing kit, right?
Yeah.
We had a buy recommendation on this going into the crash, and we think this comes back hard.
This one's been around forever too.
Yeah. Well, not as long as Johnson & Johnson.
No. But it's certainly no Johnny come lately, that's for sure. And I think it's one of those dividend aristocrats too. They're constantly increasing their dividend. Okay, next one up is Walmart, home of the "we have no more toilet paper."
Yeah, well, we believe this is the next FANG, or one of the next FANGs, and held up incredibly well. It's basically unchanged on the quarter. We had a short in this going into last summer when the global retail meltdown was happening as a result of the trade war, but we came out of that, and stocks held up well. I wouldn't be buyer. If you have cash, better things to buy. You don't buy. This is like a 5% a year grower, maybe 10.
And it's not much of a discount.
Yeah, it's not at a fire sale price. It's the same price it was 3 months ago. So
right.
It's not a great investment at this level. Too many better fish to fry.
Let's put another two others up there. One would be Kroger, KR. Is there anything going on there? It was a pretty good runner there for a while. KR, Kroger?
We don't really follow this stock. Too much of a retail flavor to it. And we hate retails forever because they're disappearing. We only looked at these as short plays. So
Well,
I'm not looking for short plays now. That trade is done. I'm looking for long plays from here on.
all right, there's a couple of companies that got discounted that were kind of like in the Walmart group. How about TGT, Target? You know, that's definitely been hit.
Well, Target is a special case. It's also another potential future FANG. It also is selling at a pretty serious discount, about 35%.
Yeah.
So this is something I might entertain if I was looking for a lower beta stock going forward. There are very few non-tech stocks we like. Target is one of them. And their same store sales are up 50% month on month against a 35% drop in the stock. That's not a bad play to have.
And what about TJX, discounter that did 18 million shares here today? It was actually up on the day. It went way down to 32 bucks. Jumped back up here to
We're gonna
47.
talk about this one. This is an industry that we don't really follow.
Yeah, but it looks like something that when and if the thing turns, it would be possibly one of the ones that comes back to life.
Yeah. I'll let
What about,
you play with your money on that one. Mark.
yeah, no, I'm just throwing ideas out there. There's more than one
So
way to skin a cat, right?
you could do a screen of stuff
Yeah.
down 80%, down 50%, and most of it's not worth buying.
No, and it's consumer oriented, so that could be a rough racket, along with Ross Stores, which is another darling that obviously rolled over just like TJ Maxx. So I'm just throwing that out there that some of these darlings on the consumer side went way down in price,
Yeah.
and they've popped back up a little bit, but they may not have quite the legs if the consumer is not as robust on
Maybe
spending
50
money.
million people losing their jobs in the next 3 months.
That's right.
I don't want to go anything near consumer.
Hey, listen, if they're not going to buy consumer electronics, they may not want to buy new pants and shirt,
Don't
right?
forget, a substantial number of consumers are going to be dead in the next 3 months.
Yeah, no, that and the fact that the wealth effect or wealth disparity is being highlighted now.
Anybody, the wealthy who had an overwhelming part of their assets in bonds,
Right.
they're looking pretty good right now.
Right. But just the fact that
they'll take greater risk to get greater returns. If you're already a billionaire, you don't need to do that.
I was really also talking about the majority of people that make less than 25 grand a year, and the majority of the people who don't have $2 grand in the bank.
Those people don't buy stocks.
Yeah. No, I'm talking about they're the ones who go out and shop, though. They go out and shop, and if they don't go out and shop, you know what I mean?
Yeah.
Well, anyway, let's talk about something more up your alley, Shopify. And Shopify was at 600 bucks almost, and then it went down very sharply, and then gave you a price at 300 to buy at last week or 2 weeks ago, and now we are at 416. Down pretty hard today, 13 bucks. But
yeah, we actually don't like this stock. We don't think they have enough added value to compete with other online retailers like Amazon. We'll buy Amazon twice instead of this and Amazon.
And the universe of companies that don't have earnings because they don't have any profits, do you think that you have to be very selective when you get in that group now, as opposed to at 3,400 on the S&P, you could get into any of them because everyone was so gung-ho on the future? Now that we've taken some of the air out of the machine, do you think some of these, no yield, no P ratio type stocks that are pretty heavily priced, do you think there could be some jeopardy in them?
Well, Tesla is one of those no yield, no PE companies, and it's a fantastic buy down at these levels. So,
So that would be on your goal. That would be on your go list. But would you increase your no-go list because of the environment we may come out of?
You really have to do your research on the individual companies, which we do. That's why you pay $3,000 a year for a newsletter.
Right.
It's to learn which companies are fluff and which companies have an actual tailwind behind them and substance to the technology. So
essentially buying the research.
I think the index days are gone. And passive investing is gone. The returns on careful name picking, single name picking, are probably going to be double or triple what the index will be for the next couple of years. Remember, the index is still being weighed down by oil companies, retailers, movie companies, cruise lines, airlines,
Right.
stuff which may never recover or may go
Right.
bankrupt first and then recover. So,
And also weighed down by small caps because those guys don't have much cash on hand because they're always reinvesting all their cash in their business. And
yeah,
so when you yank their cash flow out for 30, 60, 90 days, those guys are really going to be hurting because of the fact that obviously they don't have much cash on hand because they're a growth company.
yeah, as I always tell people, don't ever confuse gone down a lot with cheap.
Mm-hmm.
Because gone down a lot could be the path to zero.
Mm-hmm. Yeah, if the earnings go away, the price goes away.
Yeah, I've seen this happen just time and again over the past 50 years. You know, Eastman Kodak used to be a go-to
Right.
stock. 90% of the film market in the United States in 1980, they went to zero. A lot of these old Dow companies, General Electric,
Right.
almost went to zero, went down to $5. So,
Yeah. And it's having a heck of a time getting to double digits.
yeah, it's a lot of the old uh, companies, Lehman Brothers, Bear Stearns, people were buying those all the way down until there was nothing left to buy.
Well, let's jump into healthcare here, or the health industry anyway. TDOC, Teladoc Health, big run up. Really hasn't backed off much at all, really. I mean, comparatively.
Yeah, it's one of our big long-term buys. We just updated our report on this last week, I think, and it went up 25% after that. So love the company. This is where healthcare is going. It's going online. In-person doctor visits, and this is something I might actually buy at this level because we think there's another double or triple in this long term. But today, you don't want to buy that. You want to go buy,
a discounted thing.
bombed out Cadillacs and Rolls Royces.
Yeah, the idea of when you're sick and you go to call the doctor and he says, "I can see you in July," and you tell him, "Hey, I'm sick now, though."
Well, and the thing is, there are a lot of doctors in India with free time on their hands.
Yeah. But this online stuff, and that Martin Sheen commercial where, if you know how to go to a certain rx.com or whatever, the difference in your prescription can be dramatic. All that kind of stuff is the future, not the past, right?
Well, also with an online doctor visit, the doctor doesn't get sick if you have coronavirus.
Yeah, that's true. And that's going to be a big thing. TLT, we know it had a big blow off up to 180 or 190 when there was a panic going on. Was that the panic of the generation when we went up to 180 there?
That was the panic of the century.
Yeah,
when you
I
get
think
a
so.
40 point range in the bond market in 2 weeks,
Right.
you just want to stay out. I mean, right now the government essentially owns the bond market and is controlling it. And I'm not sure I want to bet against that long or short. So, plus there are just so many other opportunities in the stock market that do offer great value. The only way to get involved in the bond market is to find these high quality 10% yielding bonds, buy them and sit on them forever, and then never touch another stock.
Yep. Last one we got up here is telephone. And if we're going to look at telephone, we might as well look at Verizon as well. But let's start out with AT&T. And what do you think?
Yeah, we've been predicting this company is going to disappear for a very long time. This was one of our favorite shorts. We quit shorting a few months ago because we just, had milked it for too long, for too much. All these big phone companies are going to disappear eventually. As their technologies are superseded. So, and I don't care how much dividend they pay, I don't want to go near it.
This guy, Paul Singer and Elliott Management, you're not impressed that they're involved? You think they're just going to find this to be one of their losers, or what do you think?
Well, they have different goals than you do. They also have different resources. They're advocating for board seats and things like that. And there's a breakup valuation to this company that is worth looking at. but only if you have a huge legal team to actually participate. So this has gone beyond what individual investors should be interested in.
And if they broke it up, it might be bye-bye to the common, and only the senior secured and stuff like that would make any money.
Yeah, or the debt. The
Right.
debt is always the play in these breakup deals because.
All right, but this next one, this next one, Verizon, does seem to be a little bit more, popular with the 5G crowd, et cetera, et cetera. Do you think this is a different animal than AT&T?
It is, but it's still in the same industry,
Mm-hmm.
and there's a lot of not a lot to draw me to this, given what else is out there right now.
Right.
I mean, would I be buying, Tesla down 60% or this thing down, 30% or 50%? I'll take Tesla all day long in that situation. What's the long-term growth story in this company?
Yeah.
That isn't much.
No, I've heard people have a similar view to you in that, when you come out of this drop, you want to come out with a very aggressive portfolio, meaning tech and growth, as opposed to when you went into this thing, you probably want to cut back risk. Even the guys who go 60-40, when we were up at 3,400, they probably should have gone 80 bonds, 20 stock. And now that we're down here in the 2000s, maybe they'd want to reverse that and go 20 bonds, 80 stocks.
Yeah, or 0 bonds, 100 stocks.
You got to be a little, John. You got to be a little conservative, just a tiny bit.
Now you're talking to the wrong guy. The old balanced portfolio idea is dead because it would require you to put half of your portfolio in an instrument where it's mathematically impossible for it to go up. It either goes sideways or down huge. So if you want to run a balanced portfolio now, do half high dividend stocks and half aggressive growth stocks. And that will vastly outperform any other combination you come up with.
Well, here's the deal. We're at the top of the hour. And so obviously we're going over the audience's top 15 that they'd like to listen. But you also have obviously quite a number of your own in your proprietary materials. So this would be a good time for letting people know how to get a hold of you and, any special offers you want to give out or whatever. This is a good time to do that.
Yeah, just do a search for Mad Hedge Fund Trader. We'll pop up. You'll find our website. You can sign up for our free research there. And from time to time, we make special offerings. So if you want to add 50 years of trading experience to your own, just go to moderator.com, and I look forward to working with you all.
Yeah, this is a time where, people do have time on their hands, and maybe they're not so happy about how their procedures have worked out. So by looking into what's out there in all the different areas, you can gather information, and then you can determine how you want to, which is up your alley and which is not. So find out first what's going on out there, and then take the information in while you have the free time, while you're all locked up into the house. For people who'd like to get my weekly market update, simply send an email to optionprofessor@gmail.com, and we'll put you in the queue and make sure you get it once a week. Right now, I'm going to turn it back over to David Kosmider. Thank you very much, John, for being here with us, and do take advantage of the information that John can give you and see if it might be right for you. David, back to you.
All right, thanks, guys. Great show. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast network. And you can also go to TimingResearch.com to get access to the archive of this or any past shows. And I just want to thank my guests again for today, John Thomas of MadHedgeFundTrader.com and Jim, the Option Professor at OptionProfessor.com. Thanks, everyone.
Take care.